IIP data is due today. What are the expectations? Thoughts on that from Indranil Pan, the Chief Economist with Kotak Mahindra Bank. Indranil, at Kotak Mahindra Bank, what is your IIP? What is the big IIP number you're betting on?
We are looking at a 7.5. That is a bit of an improvement from the 6.8 of the last month. But sorry, let me warn that the most of this improvement is on account of base effect, because what we are looking at is the index in most of the, in fact, all the categories of the production-based IIP. We are looking at lower numbers, and yet the YOY growth is basically on the higher side.
Indranil, that's pretty much at the higher end, your estimate of 7.5, because most estimates are ranging between 6.8 to about 7 to 7.2. What sectors do you think would contribute to the IIP growth this time?
One, from the use-based side, I think the capital goods production is likely to show a positive number compared to the negative number that it was showing in the last couple of months. Definitely, pre-budget sort of pickup in terms of the CV sales should be one of the factors that determine the February capital goods production numbers, and that's also quite apparent in terms of the SIAM data that we have seen. Secondly, if you remember, the last month we saw a very sharp 40-42% growth in the consumer non-durables. To a certain extent, that is likely to moderate in terms of the YOY number, but it's still sort of likely to remain firm at around 20-25%. So I think these are the two most important factors that we see, and again the infrastructure sector, electricity, likely to be on the stronger side.
Indranil, do you think today's IIP data could have an impact on Reserve Bank of India's credit policy, which is due on 17th?
Not really. I think overall the broad expectations in terms of the GDP growth from the CSO is 6.9%. One of the key factors that the Reserve Bank was looking at was some amount of fiscal consolidation, and if I were to read the Reserve Bank's mind, I think they are more in terms of how subsidy containment needs to happen. From that point of view, I think there's a clear statement in the budget that the budget wants to cap the subsidies at 2% of GDP. So that should be a positive signal from the fiscal side towards the monetary side. So I would still bet on the Reserve Bank going in for a 25 basis points cut. And tomorrow's reading on the WPI inflation, we are looking at around the 6.5% figure.
So what's your IIP as well as GDP figure for the financial year close, for the full year that is? The GDP figure is about 6.7%. We are still sort of holding on to that because what we see is there could be some amount of sort of deceleration that continues to happen on the services side of the picture. And overall, the WPI, as I said, we are expecting the year to end at around 6.5%. Now, that might apparently look comfortable, but overall, from the trajectory that we are looking at, we are not really expecting any significant drops from there on, and it could only be on a slightly rising trajectory. You just pointed about inflation. What about non-food inflation, in particular fuel? And with the way we are seeing an escalation in international prices, do you think that could be the sticky point going forward?
Again, I think there are a lot of sort of sticky points in terms of the inflation, and you were just mentioning the global supply factors. But I think what the RBI sort of possibly would be looking at is that from the fiscal side, if there's a consolidation that is due, which necessarily means that oil prices are likely to be passed on to the end users. So that is likely to lead to inflation, but that also implies that there would be demand contraction because of this oil price increases. So I think the RBI needs to very genuinely and carefully weigh the positives and the negatives of inflation from the international perspective. I think more crucial for inflation from the FY 12-13 perspective is how the currency behaves, and what is the reaction from the global central bankers in terms of liquidity infusion in the system, which necessarily points out to what is the type of cycle that the commodity prices in a broader sense of the term would be looking at.
So, Indranil, do you expect Reserve Bank of India on 17th could surprise the street with a CRR cut and with a rate cut?
CRR cut, I think, is slightly unlikely, because I think what is happening on the CRR side is we are already down to 4.75%. While there is no regulatory floor in terms of the CRR, I would hesitate to believe that RBI would be extremely comfortable on driving CRR down below 3%. So that's one thing that we really need to look at. So the space available on the CRR is just about 1.75% from now on, from that sort of an argument. And definitely to a certain extent, liquidity in April and possibly also going into May, assuming that there is no huge sellout from the forex side, sort of appears to be a bit more comfortable than what we saw in February and March, on the basis of higher government spending. Some big size redemptions are happening in April and May. So overall, I think there is not too much of a concern in terms of liquidity in April and May, and could be capped at about 1 lakh crores, which should be okay with the RBI.